Francois, thanks so much for your time. I mean, now we're looking at the performance of the JSE for this year, and it's really done very little. But of course, it's not just this year. It's been a number of years where the all-share index has just been struggling to make headways. I mean, in this difficult environment, how are you looking to find value?
So I think a lot of investors have been quietly frustrated with the performance they've received out of the JSE. Let's say in the last almost 3 years now. And funny enough, way back when, in about 2012, 2013, many of the fund managers came out and said, listen, don't expect the returns out of the JSE in the local market that you have seen in the last, let's say, a couple of decades. And that now really has come to the forefront. And in a sense, yes, local growth has disappointed, and the rand has been on the back foot since 2016, strengthening, and now again we see a second wave of weakening. Investors are also quietly, very, very frustrated about offshore markets doing very, very well, and the JSE lagging in dollar terms substantially. I think year to date we're probably down 20% in dollar terms.
Sure.
Yeah.
That's a lot of money lost. I mean, so now where do you allocate your monies? And especially given that the rest of the world is also not much of a calmer place. You look at what's happening with the US and China, with the trade war, you look at what's happening in Europe and the UK with the Brexit. So where is money actually growing?
So we've seen exceptional performance out of the US, and since year to date, there's been exceptional divergence in performance from US equity markets versus European peers and Asian peers, and obviously the emerging markets in the last couple of months being battered even further. So the US has definitely been the place where the returns have come from, and on the back of obviously a stronger dollar, that has definitely helped together with strong wage growth out of the US. And also you probably see a lot of asset managers trying to get that offshore exposure to the largest weighting that they can, but also we're very confident in saying, well, if you're going to take money offshore and you're doing it for the right reasons, then the rand fluctuation shouldn't be that much of an important factor in your financial plan.
I mean, Francois, because that US bull run, right, it's been the longest in a long time, or the longest in history, right? So now everybody's talking about what goes up will eventually go down. So is now not too late to want to go and increase exposure in the US and take advantage of, rising stock prices there?
Well, consumer confidence in the States is still very, very high. And I don't think interest rates will be rising to such an extent that consumers will have expendable, extra income, totally taken out of their pockets. So there is still room in the US. Obviously, the tech sector has done exceptionally well, and we're very cautious of the valuations there. And it's also a sector that's done well for us in our international equity portfolio. But there are stocks out there that can hedge against a rising interest rate environment. Stocks with a very good balance sheet, stocks with defensive earnings. So if we do see that change in cycle in the US and globally, there are stocks that do show value in that sense, and that's exactly what we try and do.
All right, so you're saying tech is expensive, so which stocks are you talking about there, or which sectors maybe?
So the big obvious ones like Amazon, Facebook, Apple, those are the likes. But if you go and look at actual valuations, you'll probably still see Amazon growing at 150% compoundedly their earnings in the next 2 or 3 years, right? So there's still, at least it's expensive, but it's not exceptionally expensive when you go and look at forward earnings. Other things, for example, like we had Medtronic in the portfolio doing exceptionally well for us, a medical instruments company. But the moment that the earnings comes off and the forward earnings comes off, then the stock all of a sudden goes to a 25, 30 PE when the earnings aren't growing at even 10%. So that's kind of the metrics we look at. So as long as the earnings growth going forward talks to the current valuation, we're comfortable with the stock.
So other than the US markets, which other jurisdictions are you comfortable with?
So we're also very strongly looking at emerging markets. It's a bit of a timing issue given the strong dollar, given the fallback we've seen in emerging market shares. But we are looking at emerging market stocks that can take advantage of the growing Asian middle class. So things like Ping An, things like AIA, Hong Kong Exchange and Clearing, with additional trading going through those exchanges. So there's definitely value in those sectors, or those those regions, if you want to call it that. And then it gets to, well, how do I invest in those kind of, those kind of portfolios? And that's why we've launched our exchange traded note that references our international equity portfolio.
Sure. Yeah. What about Europe, UK?
So Europe is still okay in terms of growth. We probably see the UK being a bit of a laggard still with the unknowns of Brexit. We don't own any of the UK listed shares at this point in time. I'd probably think the more defensive European stocks like Nestle and ASA would probably be the better bets at this point in time.
Okay. Well, Francois, we will leave it there. Thanks so much for your insights. That was Francois Strydom, who is Momentum Securities Portfolio Manager.